Welcome back. This week we are walking through our quarterly market update with some charts, some information that is pertinent to your investing journey, things that you might have been talking about in your own lives, things you might have heard, you're curious about. Looking at a little review and then what to expect going forward and how we're thinking about our investment strategy. So as always, we start with a disclaimer. This material is prepared for informational purposes, right? You should not take it as investment advice, as with all of our podcast episodes and videos in the past. Obviously, investing involves risk, and it's difficult for us to forecast personal investment recommendations for you in a recording like this. But we do hope it's helpful. If it sparks questions, interests, you certainly can reach out to us. We'd be happy to talk through your situation with you or help you find an advisor near you. So Mike Eklund is here again, joining this week. So let's kind of dig into how things have looked so far. It's been a wild year, but let's talk about the second quarter.
Yeah, thanks, Chad. Glad to be on and talk about what's going on in the investment markets today. The chart included on the slide is the returns through June 30th of 2025. And you'll notice in the second quarter, it was a very strong quarter for stocks in general, not only U.S. stocks, international stocks, all up over 10% in the quarter. So obviously we have a slide coming up that talks about it. Definitely was not a straight line. It was a bit of a roller coaster, as we'd like to say, but a very strong quarter for the stock market. And then even over the last year, all markets up, between 14 to 19%, which is very strong. So it has been a strong and a good time to invest, as well as with bonds, as well, with returns around 6% over the last year and 4% this year as well.
Yeah, and I'll mention, as if you're a podcast listener, because we are doing a dual recording here, we have these slides. You can check out the show notes, and we'll have a video there that you can reference if you'd like to look at any of these that we're walking through. But as we move to this next one, it looks like a roller coaster ride here that we went through.
Yeah, no, I know. I made the comment earlier. The key thing about a roller coaster is you got to stay in your seat, and this year so far has been a perfect example. So this is just the U.S. stock market, or the S&P 500. Showing return, or what's happened since early January. Market was up through mid-February, and then as the tariff announcements came out, and then obviously Liberation Day, we saw the U.S. stock market drop almost 20%. And as a reminder, that's not uncalled for. A typical year, the stock market is down between 14 to 15% at some point during the year. So it's not uncalled for to see market declines. It's just the speed of when it occurred. I mean, there were days when the market was down 5 or 10% in April, which was a little bit of a shocker given some of the announcements. But as you see by the graph on the screen here, is by the end of the quarter, end of June, and through actually July as well, as the S&P 500 had moved higher and set new highs. So if you just invested on January 1st, went to sleep, woke up, or didn't look at your account for the next 6 months, you probably would have said, hey, it's been good so far this year. You didn't realize it was a little choppy on the way there.
Some great reminders here that, declines have been temporary, right, up to this point. And the speed at which the markets are moving now, you have certain opportunities that might crop up. And that's often, if you're busy in your own life, not paying attention, where, an advisor can help you out there in letting you know what's going on. So some of that might be caused by our next topic here.
Yeah, tariff is the word of the year, I think, so far. This is the graph here, or the chart here, is a shifty tariff policy. And I think that's pretty explanatory by all the details on this page of all the different announcements. I think I've said this on the last podcast we did on the first quarter market update. Tariffs are like a light switch, right? So you can turn them on or off. You can adjust the percentages. And that's what the challenge is right now for businesses and the markets, is they are trying to evaluate kind of what is the long-term impact? What is the likelihood that they remain in place? What are the likelihood that they are turned off or removed? And, what is the percentage impact to, companies' earnings? Because at the end of the day, that's what the market cares about. It cares about future earnings from companies. And tariffs are a corporate tax. It's a tax on, the company that's receiving that product or that service. And as a result, their question is how much that's going to impact their earnings in the future. And the market's trying to discount that back to the value today. So as you can see, it's been a challenging year to evaluate what that impact of the tariffs will be.
Yeah, how much is going to be negotiation, right? You didn't mention the taco trade there at all.
I thought about it, but I did not mention that. Yeah, so there is I know, so that's why I called it a light switch instead of that was the easier way. But there's a belief that a lot of these stuff is just a negotiation, and at some point it will be turned off to instead of the full impact of the tariffs. But I don't know. I'm not a politician. I don't know what the plan is over the long term.
It's just another example of how quickly things can change. The short term unknown of how this is going to play out, of what the ultimate impact is, but it can have real effects in the short run if the long run outcome is forecasted to be serious, right? But even still, we made a rebound since then. So some great lessons there that we've continued to reiterate.
Yeah. Last comment on that, Chad, is the one benefit of these roller coasters is it does provide some opportunities. That's something we do here at Financial Symmetry. We do see those declines. There are things like we could buy because we get alerts in our rules-based investment process that it's time to purchase stocks now, or things like tax loss harvesting. There was a big tax bill that recently came out, but there's opportunities to, this is not for this podcast, but to move between one investment to another to save on taxes this year. So it's not all bad when we see this amount of choppiness or volatility in the market.
Yes, you can check out our last episode, actually, with some detail on the big, beautiful bill, the tax legislation that came through, to see if there's anything there that might be impacting you as well. But as we move to our next slide, it's very interesting dynamic here, right? Because diversification has come back in vogue, maybe you might say.
Yeah, and you notice that in the first slide I showed is the strong performance over the last year and this year. So, for example, for international stocks versus U.S. stocks, and that's been really the last 10 to 15 years, we have not heard that. We've heard people have been questioning whether or not why to invest internationally. We've talked about that in a previous podcast and YouTube video, so I won't go in detail there. But one of the benefit of international investing is there are time periods where the U.S. dollar gets stronger and there are time periods where it gets weaker. And this is a very long graph here from 1970 through so far this year. And you'll see there are many different cycles of dollar strengthening and weakening. But so far this year, the dollar has declined about 11% versus the index, the DXY index, which compares the strength of the dollar against a major basket of currencies. Now, the benefit is when the dollar weakens, your international investments, which hopefully all financial Symmetry clients have, as well as hopefully you do as well, they actually benefit from that. So they not only have the returns in their own home country in the local currency, but they'll also be benefiting from the decline of the dollar as well.
A nice short-term benefit we've seen there, and these trends have lasted for long periods of time, right? At times in the past, so something to take note of there, that it could be a longer-term thing we're looking at. So as we move to the next topic, this is one. Anytime any particular asset class tends to have solid short-term performance, you start to see a spike in interest, right? And this asset class is one of those we're seeing right now.
Chad, gold is back. It's time to talk. It's the hot topic. Gold, and definitely crypto. Those seem to be the two main topics of people saying, "Hey, is now the time?" They've seen recent performance. It's like we saw last year with the Mag 7, which I called it in the U.S. The big Nvidias and Apples of the world. But now it's turned to gold and to crypto. The challenge with both of those, and gold, we have the graph here kind of comparing gold performance since 1970 to 2024 in what's called real return, which is after inflation, is things like that don't produce anything. There's no earnings, there's no dividends, there's no income whatsoever for gold. And so the challenge is, what if you buy gold today, in 10 years from now, you just still have that gold. Whereas if you buy a bond or you invest in a company, that company over that time period hopefully will generate cash flow and dividends and potentially interest, and that will become back to you as the owner of that investment. So gold typically go through these streaks of, it gets hot and then it will sit around for 10 or 20 years, and then won't have very little to almost no return, as you notice here by the graph as well. So Financial Symmetry, we don't recommend gold. We don't feel like it's more speculative than an actual investment. But just keep in mind, there always are going to be certain, I'm going to call it investment, certain items that will get, be hot and cold during certain time periods. And right now it seems to be gold is the flavor of the month.
Yeah. And that's interesting there, because you can see, the peak in 1980 for gold prices, and it took 30 some years for it to reach its next peak in the early after 2010, right? 2015 in there. So it can be very long periods of less than stellar performance if you're investing near a peak price.
Yeah, no, thanks, Chad. So this is the federal funds, which is really the short-term rate, which is, very, very short-term. This doesn't, the impact on mortgage rates or on auto loans is minimal. So I wouldn't, tie that directly to those two, but it's really driven by the Fed decides on mortgage or on their rate based on really two main factors, which is inflation, and then also unemployment. So if those are, low, then typically the rate, it depends on how those are performing, whether or not there's an issue or not. What we see right now is, and this rate will also drive kind of as Chad mentioned, the rate that you're receiving in your bank account is at about 4.38% today. It is expected to decline to somewhere between 3 to 3.5% over the next couple of years. So that would mean from the direct impact for the consumer is lower bank account interest. So for those of you sitting on cash thinking like that's a good long-term solution, over time, the expectation is that cash in the bank would earn less. So cash is great for emergencies, from very short-term needs, but anything longer, you should really evaluate your investment philosophy to figure out if you have the right amount set aside.
Okay. As we move to the next topic, we have this in most of these conversations that we walk through, kind of the 10-year outlook of experts, right?
Yeah, and this is just Vanguard's. I think we mostly have shown Vanguard in the past, but there are other folks like Charles Schwab has this, JP Morgan, BlackRock, it's an outlook, right? So there's no guarantee. It's just based upon expected earnings, expected, cash flow, and then the value, what you're paying for that asset today. This is over the next 10 years. So that's the one thing. I think 10 years in investing now is like a lifetime. I think most people think long-term is like 6 months now, but the reality is 10 years. There is some historical correlation to be able to predict what's going to happen next. Now, there's not guarantee because a lot of these folks have been wrong in the past, but the current projection is that the highest return investment or asset class for the next 10 years is likely to still be international stocks, even after their strong recent performance. So it's still looking at international stocks as a strong option. And that includes companies in Europe, Japan, Australia. The other one on that list is what's called U.S. value companies. So U.S. value companies would be companies like JP Morgan or Cisco or Johnson & Johnson. So it's a little bit different than what's called U.S. growth companies, which you see on the list here is probably the lowest return expectation. Those are probably the ones that are more popular today, the NVIDIAs, the Meta, the Microsoft. And so those are great companies. I don't disagree that they're not great companies. You're just paying a very high price for those companies. And a great company doesn't make a great stock. And the concern is over the next 10 years that the price you're paying that might not justify the valuation.
So this is all interesting information. It's good to take it and think about it, how it impacts your personal situation. But we do have some takeaways here. Because the question then becomes, after you hear this, what do you do now, right?
Yeah, and we provided that, but we're not saying, hey, let's go, put all your money in this area of the market or this stock or U.S. stocks, international stocks. We're going to talk about this in a second. We believe in global diversification, owning all companies in the U.S. and internationally as well. But in the short term, what can you focus on? It's what you can control. Likely if you're working, you have maybe saving in a 401k or a Roth IRA or putting money aside in your child's 529 account. So that's obviously your savings. You want to make sure you set aside whatever your targets are for the year. And that's great. If you have a financial plan, hopefully your financial planner has set those aside for you. So you kind of have a sense of what the numbers are you're looking for. And then if you're retired, there's likely a spending target. How much can you spend and still be okay? We love when clients spend and enjoy their money. We just want to make sure it's in line with the plan and make sure they're okay over the long term. With the investment plan, it's important to stick to it. And I know that sounds cliche and pretty simple, but this has been a perfect year where, in April, a lot of people are questioning, should we make changes? The tariffs were something haven't been talked about in much detail for 100 years. Like this is different. Mm-hmm. But it's important to stick to that plan in good times and bad times. And then, finally, tune out the noise. For clients that listen to this, they know that I always remind them that there's no benefit to watching the news. They want clicks. They're not trying to help your in retirement portfolio. So there's no benefit to listening to the media more than you should.
Yes, it can be expensive. That's why we have a rules-based process, right? That's what, and you can follow a link there. And then also we'll talk through it here on this next slide as a reminder.
If you're listening to this and you're not a client of Financial Symmetry or work with an advisor, what is an investment plan or investment process? Well, this is just a high-level look at our 3-step investment process at Financial Symmetry. We believe to keep things simple, not complicated. And from a highest perspective, we want to own as much in equities or stocks as your plan allows. We want you to be as diversified as possible. And like I said, there's over 10,000 public companies in the world, and our clients will own all of them, which is great because we don't know what the next NVIDIA is going to be or Microsoft. And then finally, like we saw this year, is importance of rebalancing. Helps you avoid fads and fears. Like if something gets really hot and expensive, we're probably going to be trimming that. And if the market declines, that's an opportunity to buy at a lower prices, which is buy low and sell high. So it goes in more into detail than that in our overall long-term approach. But I think this is from a high-level perspective how we help make a difference in our clients' lives.
Yes, and if you don't have a strategy or have wondered about if your strategy is right for you, how much you should have in stocks, bonds, cash, different asset allocations, how you should be withdrawing from your portfolio, how you should be planning big purchases, that is something we talk about in the context of a customized, independent plan focused on you and your circumstances. So you certainly could reach out to us for questions on how to put that together. You could also just go to our website and there's a button there, talk to an advisor. You can fill that out and you'll hear from an advisor very shortly or someone at our firm to get you set up for that. Otherwise, we've got contact information. You can reach out to us as well here. But a lot of good information on our website. We've had over 200 different shows, episodes, videos on different topics. You can search our website there. As always, we love feedback. You can reach out to us and provide other show topics, other questions that you might have, and that helps us to make episodes in the future that are focused on you.